Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
As we make our way through the Q4 earnings season, amid all the other news that's going on out there, we thought it'd be a good time to once again check in with our research director, Shiraz Mian, and take a little test sample here on what you're seeing as these weeks progress. We've got some pretty big names reporting this week, but we'll start with the fact that growth has returned. And
yes.
You've been talking about that for
right.
a couple of weeks here. But I have to ask, was the bar set a little higher for this period than in previous quarters?
Yeah, that's a very interesting development, if we could call it that. Typically what happens is that 2/3 of the companies are expected to beat earnings estimates, about 50% revenue estimates, and companies typically do better than that, and that's been the consistent theme last few years. What we are seeing in Q4 now is that even though growth is coming in better than expected, Q4 growth, as you mentioned, is on track to be the highest in 2 years and 8 quarters, but the proportion of companies beating estimates, earnings and revenues, is tracking below what we have been seeing in the recent past. So I think that's a reasonable conclusion to draw from what we have seen thus far in Q4 results, that perhaps estimates for the quarter did not really fall as much as we had been seeing over the last few years.
All right, we're going to talk about going forward in
Sure.
just a minute. But
Yeah.
first, let's take a look at that scorecard again.
Okay, so I have this busy-looking table here, which is the Q4 scorecard as of today. We have 171 S&P 500 companies have reported results. It's about 34.1% of the index's total membership. So we are about 1/3 of the way through with the earnings season.
Okay.
Total earnings are up 6%. Total revenues are up 3.1%. This is for the 171 index members that have reported results. And 64.3% are beating EPS estimates. And this goes back to what you were talking about earlier, of estimates being perhaps a little bit higher than has been the case. And 54.4% are beating revenue estimates. And when we put these results in context, this is what this slide does. On the left side, we are comparing the growth we have seen from these 171 index members with what we have been seeing from the same sample of companies in the previous quarter, then the 4-quarter average, and the 12-quarter average, meaning 3 years. And you would see that the growth, both for earnings and revenues, is tracking above what we have been seeing from these companies in the past. The right-hand side chart, it shows the proportion of companies beating estimates. And this is the point that you were alluding to earlier. Companies are not beating estimates at the same proportion as we have been seeing prior to that. One quick addition I want to mention here, it's the impact of the finance sector.
Okay.
We have had very strong growth from finance sector in Q4, and that is giving a very helpful bump to the aggregate growth picture. So I wanted to show the aggregate growth picture for the index with and without finance. The left-hand side chart shows the growth as it is with finance. The right hand is without finance. Without finance, the growth drops to 3.9% earnings growth on 3% revenues versus 6% for earnings growth with finance. So it's not as impressive as it is with finance, but it's nevertheless better than historical periods.
So finance, to say the least, a big mover here in these reports that are coming out.
Absolutely, that's right.
All right, so this week also we've got some decent tech companies reporting. Even though you've got Apple, you've got Facebook and Amazon, even though the last two might fall into other industries, technically
That's right.
you can lump them into that
Absolutely.
tech group
That's right.
on the aggregate. And you have some other potential market mover names that are going to be reporting as well. So let's zero in on tech.
Okay.
What do you see for tech in the aggregate?
I brought this one table where I was going to focus on a number of these major sectors. But since you have ambushed me with technology only, so let me just focus on technology.
Okay.
And you will see that the top highlight is the technology sector, and you would see, and this is the combined Q4 summary picture.
All right.
So this combines the actual results that have come out already. You would recall last week we saw results from Microsoft and Google and a number of others, and then estimates for the still to come reports. Apple, Facebook, you mentioned, so all of those will be coming this week. Apple, incidentally, is tomorrow on Tuesday. Facebook is on Wednesday after the close. So 5.9% earnings growth for technology sector as a whole, and 4.4% revenue growth. So when all said is done, that's the expectation for the technology sector as a whole for Q4. We should keep in mind that Apple is a drag on the sector as a whole. We'll see how the iPhone maker does tomorrow. But the expectation is that Apple's earnings will be down about 7 to 8% year over year on essentially flat revenues. If you exclude Apple, which carries a lot of weight in the tech sector, then the sector's growth moves into double digits. The expectation is that on an ex-Apple basis, earnings for the sector would be up 11.4% on 5.5% higher revenue. So it's kind of a middling quality growth with Apple. And pretty strong growth on an ex-Apple basis.
It'll be interesting to see if that report puts any more downward pressure on the market after it comes out.
Most likely, results would be better than what is reflected in these numbers. I would expect that it's not a year-over-year decline. It's most likely flat to perhaps a modest single-digit growth for the tech giant. And if that's the case, that should show up in the aggregate growth expectations for the sector as well as for the index.
All right, as we sit here and talk on January the 30th, correct me if I'm wrong, but I've noticed that some of the bottom line forecasts have hardly budged
That's right.
from earlier forecasts. And so does the hurdle get even more difficult for these corporate executives to clear over the next year?
Yes, and I think it's a continuation of what we discussed up front when we mentioned that that companies are not beating estimates for Q4 as easily as historically been the case. And we actually had been pointing this out in the run-up to the start of this earnings season when companies were reporting Q3 results and they were guiding for Q4. Estimates for Q4 had not really fallen as much. So the conclusion from that, which one could reasonably draw, is that perhaps estimates had not fallen as much. And we are seeing something similar for the Q1 17 estimates as well. So yes, you're right. Estimates are not falling as much as we have become accustomed to seeing over the last few years. And perhaps that is setting the hurdle rate higher than has historically been the case.
Our company executives may be tempering their future outlooks because of unknowns with the new administration in Washington, the strong dollar, and its effect on some of these multinational companies?
I think all of the above. The net effect is positive on top of that. So the hope is that whether you're looking at finance, whether you're looking at some of these other multinationals that sell a lot of stuff abroad and are exposed to what's happening to the US dollar. And then on top of that, there's this uncertainty of how the new administration's trade outlook and trade policy will really translate. So there are a lot of unknowns, but the overall mood on the street appears to be positive and favorable. So they are mentioning these uncertainties and these unknowns, but at the same time, they're also referring to expectations of improved growth in the U.S. economy, which should offset either entirely or partly those expectations.
You mentioned first quarter 2017, And so we always have a tendency to look at the negatives first.
That's right.
How are the negative outlooks for the first quarter trending at this point?
So the historical trend has always been that estimates for the current period, which is 2017 Q1 now, it starts coming down as the earnings reports for the previous quarter, which is 2016 Q4 in the current case, when those reports come in, managements typically guide a little bit tepidly for the current period, partly as a result of managing expectations and partly as a true reflection of ground reality. So estimates for Q1 have started coming down as well. Before I show you the evolution of Q1 estimates, here's how Q1 stacks up. And you could see that the current earnings season, the 2016 Q4, that's the 5.3% earnings growth. That's the combined composite or blended earnings growth for the quarter. When you combine what has come out with the estimates for what is still to come. So 5.3% is an improvement over 3.8%, which was the first positive earnings growth after 4, 5, 6 quarters of earnings declines, and it's expected to move up. So it's 8.7% in 2017 Q1, and this 8.7% has come down over the last few weeks as the earnings season has unfolded, and that's what we see in this slide. At the end of December, just prior to the start of Q1 17, the expectation was for 10.4% earnings growth in 2017 Q1. As of today, it's 8.7%, so it doesn't look pretty.
Not a big drop, though.
Not a big drop. So that's the key point. It's at this stage, in prior quarters, we had seen much bigger drops. And we saw something similar take place in 2016 Q4 estimates as well. And this is tracking a little bit even better than 2016 Q4. So it's still plenty of ways to go. As we mentioned up front, it's about 1/3 of the way, 2/3 are still to come, so this could change. But as of this stage, this is providing a reassuring picture of the evolving earnings picture.
Well, if you want to talk about reassuring, did I see correctly on that previous slide that 4Q17 was looking for 11%?
That's right. It is. It's very strong growth. In
Almost
fact,
12.
In fact, the momentum is expected to build in the following quarters. We had flat to modestly down earnings on a full year basis in 16 and 15, and double-digit earnings growth in 17 and 18. So yeah, the expectation is for some material ramp up in earnings growth this year and next.
Barring anything unforeseen that would stall it out.
That's always the refrain. Yeah.
Always the wild.
That's right. Yeah.
All right, we're going to check in with you again at least one more time before the season ends.
Sure.
In the meantime, don't forget to keep your eyes on Zacks.com, because there is where Shiraz writes his earnings commentaries. He has earnings previews every Monday and earnings outlooks later in the week during the peak reporting times. You want to keep an eye on both of those reports. With Shiraz, I'm Terry Ruffalo.